Hello everyone, welcome back to the channel. Today I'm going to be explaining why support and resistance no longer works. I'm going to be doing this by explaining certain liquidity concepts, certain smart money concepts, and explaining a general overview of the mechanics of any financial market, not just the Forex market. I'm not going to leave it there, however, I'm going to offer you an alternative strategy using those same liquidity and smart money concepts, but this time to your advantage and to make you money rather than losing you money as support and resistance does a lot of the time. And I do have a diagram that I've drawn out that isn't a live chart, so that I can explain every part of the strategy and every part of a trade using that strategy very clearly. However, before I do that, I'm just going to start by explaining a general overview of the mechanics of the Forex market. So in any financial market, not just the foreign exchange market, there are two main types of market participants. There are people called market makers and retail traders. I suggest you screenshot this, by the way, because then you can look back at this and maybe do notes on this if you're just coming into the smart money space or smart money space as a whole. So there are market makers and retail traders, as I said. Market makers are going to be people that have access to large amounts of money. So they're going to be people like investment banks, for example, Goldman Sachs, JP Morgan, Deutsche Bank. There's a lot of other ones that I'm not going to name. Hedge funds, multiple hedge funds. You may have heard of one recently called Melvin Capital that lost a lot of money because of GameStop. Pension funds. Generally, institutions that have access to millions and millions of pounds, if not hundreds of millions of pounds, if not billions of pounds, most of the time billions of pounds. These institutions, because they have access to such huge amounts of capital, can manipulate the market and affect the price of an asset very easily. The reason for that is when they short or long an asset, the price of that asset will normally follow what smart money as a whole, and that's what we call these people. We call the market makers smart money. Um, the the market price and the price action will normally follow the sentiment of what smart money think, because they have access to such huge capital. Then there's retail traders. Retail traders are people like me and you that watch videos on YouTube that get taught support resistance, that are just trying to go into the market, open an account with a broker, make a quick profit. Because we don't have access to such huge capital, such unlike these market makers, we don't have very much effect on the price of an asset, and therefore we are unable to manipulate the price of an asset. However, that is individually. The retail traders as a whole can definitely do that, and that's what that is an integral part of our strategy, and I'm going to go through that later on. Another thing that I need to explain is, in any market, not just the foreign exchange market and not even just financial markets, in order for a transaction to occur, you have to have a buyer and a seller. In the stock market, if you want to buy stock, the sellers have to be selling the amount of stock that you want to buy. If you want to go to your local Asda, the Asda is selling you something, you are buying something from the Asda. In order for a transaction to occur, that you need to buy something from that Asda, and that Asda needs to be selling something to you. A transaction cannot occur if either one of these, the buyer or the seller, isn't present, right? And that is important because normally, say I am a market maker, say I am JP Morgan. JP Morgan is is an investment bank, which is a type of market maker, right? They have access to huge capital that can control the price of an asset, right? And say I am JP Morgan and I want to buy 100 million pounds worth of Tesla stock, right? And at a certain time, 100 million pounds of Tesla stock isn't being sold, right? In the marketplace, if I want to buy 100 million pounds worth of Tesla stock, 100 million pounds worth of Tesla stock needs to be being sold for me to buy it off the people that are selling it. That's how it works. It's a very simple. There needs to be a buyer and a seller. If there isn't a buyer and a seller, the transaction can't occur. So in the case where JP Morgan wants to buy 100 million pounds worth of Tesla stock, and only, let's say, 50 million pounds worth of Tesla stock is being sold, that transaction cannot occur. And that's where I go back to the support and resistance point. For example, say at this point, right, literally everyone and their mum is looking back and saying, okay, historically, when the market came back into this resistance zone, the market dropped off. It went back to the level of support, right? And guess where we are? Where we are at right now? We're at that level of resistance that historically it has dropped from. So guess what? It has to drop, right? So what you're gonna do is you're gonna enter your sell at this point. Your take profit is going to be at that at that level of support, and your stop loss is going to be somewhere above here. It's going to be normally somewhere around here, right? But what will happen is a lot of the time, and I mean you can tell me if I'm wrong in the comments, but a lot of the time what will happen is you will be stopped out of your trade, and then it will go in your direction, and you'll be very frustrated because you were right in the general direction, you were just wrong in your entry. And now I'm going to teach you how you can get those better entries, right? And I'm going to teach you why this move happens and why this move is necessary in order for JP Morgan to open their big sells and their big buys, big shorts or big longs or whatever you want to call it. I know I use the example of Tesla stock and the stock market, but it's the exact same thing in the Forex market. The only reason why I use the stock is because stocks as a whole are a more tangible asset. Currencies are harder to understand. So I'm just going to continue using the example of stocks, but it's literally the exact same thing in the Forex market. Right. So at this point, as I said, everyone is going to be shorting this market. So let's say out in the marketplace for Tesla stock, 90%, let me just begin typing really quick. So Tesla stock, right? 90% of Tesla stock at this point, right? 90% of Tesla stock at the level of resistance. I'm typing this so you can go and screenshot this later on. 90% of Tesla stock at the level of resistance is being shorted. This doesn't happen. 90% of the stock being shorted is very bad. That doesn't happen. But let's say a lot of the traders, the day traders, are shorting this market at the level of resistance, right? And let's say the overall shorters, the people that are shorting this market, are shorting, let's say, 150 million pounds worth of Tesla stock, right? Let's just say 100 million pounds, just so we can get a round number, right? 100 million pounds. And then, obviously, if 90% is being shorted, 10% is being longed, right? Is being longed. 10% of all of the Tesla shares at this point are being longed, right? That means only 10 million pounds of Tesla stock at this point is being bought. Right? And remember, JP Morgan, they want to buy. Remember, they want to buy, and they want to buy a lot. No, they wanna sell, and they want to sell a lot. They've done their own fundamental analysis, and they believe at this point Tesla stock is overvalued, and so they want to sell this asset. But guess what? Everyone is selling, and only 10 million pounds is being bought. And say they want to open a 50 million pound sell at this price. So what I'm going to do is I'm going to do something. I'm going to draw it out so you can. So at that price, at the level of resistance, JP Morgan wants to sell. JP at the level of resistance wants to sell 100 million pounds of Tesla stock, right? But then remember, only 10 million pounds worth of Tesla stock is being bought at this price, and therefore, let's not say 100 million pounds, let's say 50 million pounds, right? Just to make it easier. Say at this point, JP Morgan wants to sell 50 million pounds worth of Tesla stock. Remember, only 10 million pounds was being bought, therefore that transaction cannot occur, because in order for them to sell that 50 million pounds, the buyers have to be buying at a minimum of 50 million pounds. The buyers of Tesla stock in the whole of the marketplace have to be buying a minimum of 50 million pounds so that they can buy this 50 million pounds of Tesla stock from JP Morgan. Think of it as a physical asset that you're buying something from a shop, right? The shop in this case, right, is JP Morgan, and the buyers are buying from JP Morgan this Tesla stock from JP Morgan, right? But then what they do is they push price up, and now at this price, this has changed. the people that are buying are no longer buying 10 million pounds, and they are no longer taking up only 10% of the total market. The market sentiment changes. What do I mean by that? I mean, at this point now, let's say 60% of the day traders are buying Tesla stock, and 60 million pounds is being bought. Well, now guess what? All of a sudden, this 50 million pound sell that JP Morgan wanted to open can now be opened, right? Because they opened a buy in order to push price up, which is what it did, because they have power to manipulate price and push price up and down, because they have assets that retail traders don't, so they can push price up into this zone. What that does is that triggers stop losses, so that means that now all of a sudden the amount of people that are shorting the market just drops rapidly, because all of these people have hit stop loss that we're selling at this point. And also what they've done is, through this move, they've triggered buy stop orders, because you'll know when you're learning support and resistance, what it is sell at resistance, buy at support. If it breaks out of resistance, buy. If it breaks out of support, sell. That's what it's taught, right? So they're going to be thinking it's broken out of a level of resistance, now it has to pop up and continue going upwards. So they have buy stop orders placed, or they're going to manually enter new buys at this point, because they believe, okay, we are no longer in this level of support and resistance, market is going to break out and then continue to the upside, right? So they are thinking, let me open a lot of buys at this point, because we are now in a bullish market. So that's why the market sentiment changes from only 10% buying to 60% buying, because there's a breakout to the upside that retail traders are going to be seeing, and also the stop losses of people that were selling have been hit. So now all of a sudden, the JP Morgan sell that they wanted to open from the beginning, and that this buy was only allowing them to open, right, can now be executed. So at this price again, 60% is being bought, and therefore JP Morgan can open the 50 million pound sell they originally wanted to open, right? What they've been looking for this whole time is to open a big sell, and now this move, this small buy at the beginning, allowed them to open that sell, and now price can do what it wanted to do, which is drop. You, if you are trading support and resistance, are completely out of the trade, because you don't understand the mechanics of the market, and you've hit your stop loss, you're thinking it's a bad day, and you're losing money, right? But the people that are the banks, the institutions, they've made money off of you losing money, right? And what you need to do is you need to find a way where you can get another entry for the long term sentiment, which is a sell, because remember, JP Morgan thinks it's overvalued. That's why they're selling, right? Or maybe some bad news is going to come out and they want to sell before that bad news. I don't know, there's multiple reasons why you would sell a stock, right? They want to sell this stock, right? So in the long term, they believe it's gonna go down, and that's what they do. They open a big sell, market goes down. But remember, we mustn't forget, although they open this sell at this point, they have a buy that they opened in order to allow them to open the sell, that at this point is running in heavy drawdown. Therefore, they have a vested interest to bring price back up to this zone, which is something called an order block, which is something I'm about to explain, in order to close those trades that they've opened, in order to allow them to open the sell at break even, so then they can allow the trade to do its thing and then continue to drop fully, right? But before they can allow the market to do that, they need to close these trades, these buys, right, that they've opened, in order to allow them to open the sells at break even. So now what they do is bring price back into this zone, normally into something called an order block candle, because there'll be an order block candle sitting there. Then the market can go down. This is when we start to become involved in this setup, and this is where we get our small sniper entries. Our stop losses will go somewhere here where the order block candle is, or here. It doesn't really matter, because the strike rate is very high. You're very likely to make a lot of money with this trade. Then your take profits can be huge, because remember, we are expecting breaks of structure to the downside, because remember, our sentiment is long term, right? We are trusting JP Morgan's analysis, and we are trading alongside the banks, and the banks are consistently profitable. Trade alongside people that are consistently profitable, you will become consistently profitable. And that's how we enter our trade. We will enter at this point and we would sell the market down. That was just a rough explanation. Now what I'm going to do is I'm going to do this on a real life example, which is right here. So if I just get this right here, and so I'm able to draw, and then I begin. Right, so what we have here is a market that has formed a level of support and resistance, a level that has respected this, a market that has respected this level as resistance, then broken through that resistance, returned to that level as a level of support, respected it again, and therefore now because we've had a support once, a resistance once, support once, traders are expecting for it to come back. So it's tested it once, come back down, and then bounce up again, and their stop take profits would be up here, right? They are expecting the market is going to bounce from this point and go all the way up into this zone. But guess what happens? Market breaks through. It does exactly what we said is going to happen at this point. So look, market, instead of going down from this point, from here, market breaks up and then goes down. And look what happens here. In this scenario, market breaks down and then goes up. Why is that? Because at this point, JP Morgan has opened not JP Morgan, but smart money is opening so many sells at this point, right? At this point, smart money is opening a lot of sells, so that they can go and then buy the market, right? So this sell tapped into liquidity that was below here, changed the market sentiment, provided the liquidity for them to open their buy at this point. So then what happens is market goes up. But remember, the sell that they open at this point, when the market is up here, is losing a lot of money. Therefore, they have a vested interest to bring price back down into that zone, which is what we call our order block candle, right? And an order block candle is just a candle, the last bearish candle before the bullish push. And then what I did was I marked that on the lower time frames, waited for the market to come back, and I entered off the 0.5 of that candle, and it popped off. You see the trade completely popped off, right? It's a very simple strategy, and that's why support and resistance doesn't work. It's using the fundamental parts of the financial markets, the mechanics of the financial market. Inherently, support and resistance will not work in a market where banks and institutions are controlling it, right? And therefore, you should stop trading support and resistance, switch to a system where you can trade alongside these banks rather than losing money to these banks, and becoming consistently profitable just like these banks are. And these banks are definitely consistently profitable. They have to release their figures and stuff, so you can go and do your research on how much money these banks make, because they do make a lot of money every month trading the financial markets, and we don't. And so what we need to do is we need to learn what these banks know, or these banks use in order to take money from us, and we need to take money from them. It's becoming a kind of cliche anti-establishment thing, but no, it's not like that. We just need to learn how to make money properly, and yeah, that's how you do it. It's a very, I say this in every video, it's not very simple. It's going to require a lot of work, but if you put enough effort and you backtest enough, what you need to do now is you need to go to a live chart. So you need to go to a live chart like this, go back, replay the chart, go back here, and then do your own backtesting. That was just a random point that I replayed it from, but you get the point, right? You need to do your own backtesting, and you need to get ready so that when it happens in the live market, you are able to execute your trades and make money. So yeah, thank you for watching. Please make sure you like, comment, and subscribe, because literally right now it's 1:40 a.m. that I am filming this video. So a like would be very much appreciated. A subscription would be, clicking the subscribe button would be even better. I hope I've helped you. Thank you very much for watching the video, and I'll see you in the next video. Bye.